Are life insurance proceeds taxable when left to children? And what should parents know to plan wisely? Let's find out. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. Do children pay taxes on life insurance payouts? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So to sum it up, there's someone trying to figure out how taxes work on life insurance proceeds for their kids. They've always thought these payouts aren't taxable, but after looking online, they're getting mixed messages about estate taxes. Their big worry is if their children will have to pay taxes on the life insurance money if both parents were to pass away. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that the estate tax depends on who owns a life insurance policy, not the beneficiary. Transferring ownership to children might help dodge estate tax issues. Plus, any changes in estate tax laws can greatly affect a person's estate tax over time. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. One response points out that the 4% rule is a retirement guideline, suggesting people withdraw 4% of their savings each year. It assumes a balanced mix of stocks and bonds, aiming to make those savings last around 30 years after retirement. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that while the contracted amount paid to a beneficiary isn't taxed, any interest earned is taxed as interest. If life insurance is paid to an estate, it's subject to estate taxes, so it's important to designate beneficiaries properly. Together, these payments could surpass the $2 million estate tax exclusion threshold. All right, now that we've seen what the community had to say, here's our take on this question. Life insurance proceeds generally aren't taxable for beneficiaries. So, if a child gets a $500,000 payout, they usually don't owe income tax on it. However, estate taxes could come into play if the total estate value, including that payout, surpasses the federal exemption. To sidestep estate taxes, it's smart to name individual beneficiaries rather than the estate itself, ensuring they receive the money directly. In this video, we've covered how life insurance payouts are generally not taxed as income for beneficiaries. However, estate taxes might kick in if the estate surpasses federal limits. Naming beneficiaries directly or transferring policy ownership can help avoid these taxes on life insurance proceeds. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.